A day after the second biggest bank collapse in American history, First Republic, it was hoped some calm would return. That was after JP Chase took over all of the customer loans and deposits. Well, not so. Shares in a range of regional banks last night collapsed, and you can see them here as investors worried that more will fail if they've mismatched their assets and liabilities. You can see here PacWest Bancorp down 28%. Western Alliance down more than 15%. Metropolitan Bank down 20% as well. So let's bring in here Mark Humphery-Jenner, Associate Professor at the School of Banking and Finance at the University of New South Wales. Mark, always great to chat to you about these things. You've written about First Republic in particular. I mean, JP Chase, the biggest bank in America, one of the biggest in the world, it can't keep rescuing every one of these banks.
That's absolutely right. So even before they rescued First Republic, they already had a sizable share of the deposit market in the US, 16% of the deposits in the US. And now they've acquired First Republic. Now, First Republic wasn't massive, but it wasn't tiny. And you can't have JP Morgan acquiring First Republic, then PacWest, then everyone else. They'll just control the market. And that's something that regulators, particularly in the US, really going to want to avoid. And this is probably why we've seen the stock prices go down so much. Many of these companies simply aren't going to be able to be saved by JP Morgan. And that's the unfortunate fact.
OK, but then go back to the global financial crisis. And at that time, first Washington Mutual collapsed, taken over by JP Chase. Then Bear Stearns collapses. And remember, at that point in time, they let it collapse rather than rescuing it. And that was the trigger for the global financial crisis. They don't want to make that mistake again.
That's absolutely right, or at least they want to try to avoid making that mistake again. Now, the whole problem with the global financial crisis, well, we're seeing some resonances here, but there are significant differences. We're mostly seeing this filter into the smaller regional banks at the moment, rather than the JP Morgans or the UBSs or the Citigroups, that type of thing. So it hasn't quite gotten to that stage.
So the Credit Suisse one could have been bad, but that was papered over by UBS stepping in and taking it over.
That's absolutely right. So Credit Suisse is globally systemically important, has a lot of contracts with a lot of people. And if Credit Suisse were to fail, well, think about the counterparties. Well, they're now out of pocket. But by UBS taking it over, they stemmed that risk. They stopped the bleeding. However, if they hadn't, it would have been a whole lot worse.
OK, but in America, a lot of people don't realise that here in Australia, there are 4,100 banks. So we showed you 3 banks that had share price falls last night. Now, they're reasonably large. And I know, say, for example, even First Republic was the 14th largest bank in America. So just to give it some sort of scale and relativity as compared with here in Australia.
That's absolutely right. So in Australia, even if you're looking at the smaller banks, often the smaller banks are actually owned by the big banks. So to some extent, the risk is very, very different. We're going to have much less risk exposure than the US. With the 4,100 banks in the US, well, think about their balance sheets. How solid are they? Think about the concentration. Are the depositors all coming from one regional town? Are their loans all to one regional town? What happens if there's a drought? What happens if there's a flood? What happens if the depositors all start to lose money in that location, needing to withdraw their money? You end up with a much bigger risk profile than the US when you've got that degree of fracturing.
OK, so then there's a second thing, which is Signature Bank. It really mismatched its assets and liabilities by effectively trying to get higher returns by investing in long-dated bonds that went underwater when interest rates rose. The issue now is everybody, I kind of guess, is trying to find the next bank that's made the same mistake.
That's absolutely right. Almost every bank has that problem. Almost every bank took a lot of deposits in during the pandemic boom when people were getting cash in. Then they lent that out at really low interest rates. Almost every bank is underwater on a lot of the loans. The big issue is whether they can survive long enough to actually get the money back from those loans, whether they hedged any of that risk, and whether they're seen as being at risk of going under, whether they're seen as their profitability causing the bank to go down. And the problem with First Republic is they had that asset mismatched, then the depositors started to decrease, then the stock price went into a death spiral. Then the stock price halves, and then depositors leave. And then the stock price halves again, depositors leave. It ends up just going down towards zero due to this sentiment-driven spiral downwards.
$100 billion worth of deposits literally walked out the door. And of course, these days with electronic banking, the people aren't queuing up saying we want our cash. They're simply getting online and taking it away.
That's absolutely right. And it's even more an issue when interest rates have gone up. Because now you look at bank deposits, they're paying you, 0.1%? In the US, maybe a little bit higher. But you look at a money market fund, 5% going into treasuries. Well, you look at it and you think, well, a treasury is risk-free, in fact, less risky than a deposit, and it's paying you a higher interest rate. It's not a difficult decision that people are making. And this is one of the reasons we're seeing so much deposit flight. In addition to the fear that you don't want to have to deal with what happens when the bank goes under, even if you're bailed out by the FDIC.
Okay, so then one final part about this. The US Federal Reserve, which has a role in trying to make the banking system secure in the United States, tonight might make it a little less secure by raising, as expected, interest rates by another 0.25%.
That's absolutely right. So the market is largely expecting to raise it by 25 basis points, so 0.25%, much like the RBA did. And this is in part because inflation is still stubbornly high. A lot of the regulators and a lot of, well, to some extent, some of the commentators in the finance space seem a little bit complacent about how bad some of the economic situation is, how bad it is for people on the street who are tightening their belt. And we're seeing some of that filter through into people's sense of well-being, consumer sentiment. But the Reserve Bank or the Federal Reserve are still hiking rates, and they're likely to do so at the moment, even though a bank has failed.
It's going to be fascinating to watch it. Mark Humphery-Jenner, we'll get you back in very shortly to talk about all of this, because I don't think it's going to be the last one. Many thanks for your time.
Absolutely. Thanks a lot.